Nina has a 780 credit score. She checks it every month, protects it carefully, and has structured entire financial decisions around keeping it high. She paid off a credit card she wanted to close because she was told closing it would hurt her score. She took out a car loan she didn't need because she was told it would diversify her credit mix. She spent years optimizing a number she only partially understands, for an audience she's never met, using rules that weren't written for her benefit. Owen has a 680 credit score. He's never really tried to optimize it. He pays his bills on time and doesn't think much beyond that. His friends tell him his score is costing him money. They're right, but not in the way they mean. Here's what neither of them understands. The credit score is not a measure of your financial health. It is a measure of your value as a borrowing customer. Those two things overlap, but they are not the same. And the gap between them is where banks make their money and where most people waste theirs. Let's start with what a credit score actually is. The FICO score, which is the model used in over 90% of U.S. lending decisions, was created in 1989 by the Fair Isaac Corporation. It was designed to predict one specific thing: the probability that a borrower will miss a payment by 90 days or more in the next 24 months. That's it. It is a default risk predictor built for lenders. It was never designed to measure whether you're good with money, whether you're wealthy, or whether a financial product is right for you. It was designed to tell a bank how likely you are to keep paying them. 5 factors determine your FICO score. Payment history is 35% of the total, the single largest component. Amounts owed, meaning how much of your available credit you're using, is 30%. Length of credit history is 15%. Credit mix, the variety of loan types you carry, is 10%. And new credit inquiries account for the final 10%. Notice what is not in that list: your income, your net worth, your savings rate, your investment portfolio, your emergency fund. A person with $400,000 in index funds, 0 debt, and no active credit accounts has no FICO score at all. A person with $200 in savings, $18,000 in credit card balances, and a history of making minimum payments on time can have a score above 700. The score measures your relationship with debt, not your relationship with wealth. Nina understands this at a surface level, but has never fully absorbed what it means for her decisions. She kept a credit card open she didn't want because closing it would shorten her average account age and potentially drop her score by 10 to 15 points. That decision cost her nothing obvious, but it left an open line of credit on her profile that she periodically uses for small purchases to keep it active. Spending money she might not have otherwise spent to maintain a number on behalf of a system that exists to serve lenders. She also took out a 6-month car loan at 3.9% interest to add an installment loan to her credit mix, which the FICO model rewards. She planned to pay it off in full within 2 months. She did exactly that. She paid $47 in interest during the 2 months the loan was open. Her score went up 8 points. She considered it a win. She paid $47 to improve a metric that banks use to price her debt. She made the bank's system work slightly better for the bank and paid them $47 for the privilege. Here is where the credit score game gets more expensive for most people. The behaviors that maximize your score are almost perfectly aligned with the behaviors that maximize a lender's revenue from you. Carrying balances near 30% of your credit limit but not higher signals active borrowing, which is good for your score. It also generates interest income for the card issuer. Having multiple open credit accounts signals credit experience, which is good for your score. It also gives lenders more opportunities to extend you products and earn fees. Taking out loans and paying them consistently over time builds your payment history, which is good for your score. It also generates months of interest payments for whoever holds the loan. The system rewards you for being a reliable, consistent, moderate borrower. It does not reward you for being debt-free. The optimal credit score behavior and the optimal wealth-building behavior point in different directions. Now, none of this means credit scores don't matter. They matter enormously in specific moments. A mortgage application is the clearest example. The difference between a 680 and a 760 credit score on a $300,000 30-year mortgage can mean a difference of 0.5% to 1% in interest rate. On a $300,000 loan, that's $30,000 to $60,000 in additional interest paid over the life of the loan. Owen's casual approach to his score has a real and calculable cost when he applies for a mortgage. Nina's careful management earns her a meaningfully lower rate on the largest debt she'll ever carry. At that moment, the optimization pays off in a way that justifies most of what she's done. The same applies to auto loans, personal loans, and in some states, insurance premiums, and even apartment applications. A higher score lowers the cost of borrowing and sometimes the cost of living in ways that add up to real money. The mistake isn't caring about your credit score. The mistake is optimizing for it beyond the point where it serves your actual financial life. Nina's score is 780. The mortgage rate improvement between 780 and her current score is approximately 0. Most lenders offer their best rates to borrowers above 740 or 760. Nina's score is already in the top bracket. Every additional point she earns by keeping unnecessary accounts open or taking loans she doesn't need is effort and cost spent improving a number that stopped helping her 40 points ago. Owen's 680 sits in a range where improvement has real dollar value. The difference between 680 and 720, achievable mostly through consistent on-time payments and reducing his credit utilization below 30%, would save him several percentage points on his next loan and potentially thousands of dollars on a mortgage. Owen should care more. Nina should care less. The practical answer is simpler than the credit score industry wants you to believe. Pay every bill on time, every time. That single factor controls 35% of your score and is the most important thing you can do. Keep your credit card balances below 30% of your limit and below 10% if you want to optimize further. Don't close old accounts unnecessarily. Don't apply for multiple new accounts in a short period. And beyond those basics, stop. The marginal returns on additional optimization are tiny. The behaviors required often cost money, and the score you're optimizing was designed to benefit the people lending to you, not you. A credit score is a tool. It's useful when you need to borrow, important when the amounts are large, and largely irrelevant to your actual financial health when you're not actively borrowing. Knowing the difference between those moments is worth more than another 10 points on the scale. Nina's 780 opens every door available to her. What's behind those doors is entirely up to her. And none of that is measured by a number the Fair Isaac Corporation invented in 1989 to help banks decide who to lend to. That was always its only job. Subscribe so you don't miss the next one. Share this video with someone before they spend another year in the wrong fund. And drop a comment below. Tell us what expense ratio you found when you checked. We read every single one.